preparing for a banking interview at Emirates NBD interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to work at Emirates NBD. My background combines finance fundamentals, customer focus, and comfort with data-driven banking. Emirates NBD interests me because it is one of the UAE's leading banks, with strong retail, corporate, Islamic, and digital banking franchises. I would highlight examples where I handled numbers accurately, served clients professionally, and learned quickly under pressure. The message is simple. I understand banking is both risk management and service excellence in a fast-moving UAE market. While answering, focus on linking your finance skills, customer mindset, and UAE banking interest to Emirates NBD's scale, digital strategy, and reputation, rather than giving a generic biography. Question 2. What do you know about Emirates NBD's business model? Emirates NBD is a diversified banking group, so I would not describe it as only a branch bank. It serves individuals, SMEs, large corporates, government-linked entities, and wealth clients across conventional and Islamic banking. Revenue comes from lending spreads, fees, cards, trade finance, treasury, and investment products. In an interview, I would connect that model to the UAE economy. Deposits, credit quality, digital adoption, and customer trust drive performance. Make sure to cover the bank's diversified model: retail, corporate, Islamic banking, treasury, wealth, digital channels, and UAE market exposure. Show you understand revenue drivers and risk priorities. Question 3. What is CASA, and why is it important for a bank like Emirates NBD? CASA means current account and savings account deposits. For a bank, these balances are valuable because they are usually cheaper than fixed deposits or wholesale funding. If Emirates NBD grows stable CASA, its cost of funds improves, supporting net interest margin and lending competitiveness. I would also mention that CASA depends on payroll relationships, digital convenience, customer stickiness, and service quality, not just pricing alone. In your answer, talk about current and savings account deposits, funding cost, customer stickiness, payroll relationships, and how a strong CASA base supports margin, liquidity, and lending competitiveness. Question 4. How do banks make money, and what is net interest margin? Banks mainly earn the spread between interest received on loans and investments and interest paid on deposits and borrowings. Net interest margin, or NIM, expresses that spread relative to earning assets. For example, if yield on assets is 5.5% and funding cost is 2.5%, the core spread is 3%. Fees from cards, FX, wealth, and trade finance diversify income, but disciplined pricing and asset quality protect profitability. Be sure to mention interest income, interest expense, earning assets, net interest margin, and fee income. Keep it practical by explaining how pricing, funding mix, and credit quality affect profitability. Question 5. How would you assess whether a customer is creditworthy? I would assess credit through capacity, character, collateral, capital, and conditions. For a salaried retail borrower, I check verified income, employer quality, debt burden ratio, bureau history, and account conduct. For a corporate, I add cash flow coverage, leverage, industry risk, management quality, and security. The key is not approving because revenue looks high. Repayment capacity under realistic stress is what matters most to the bank over the loan life. While answering, focus on the 5 C's of credit: repayment capacity, credit bureau data, cash flow analysis, collateral, and debt burden ratios. Also, discuss how corporate credit differs from retail underwriting. Question 6. Explain International Financial Reporting Standards 9, expected credit loss, in simple terms. International Financial Reporting Standards 9 uses expected credit loss, not only losses already incurred. Stage 1 covers performing assets with 12-month ECL. Stage 2 captures significant credit deterioration with lifetime ECL. Stage 3 is credit impaired, Also lifetime ECL with interest recognition affected. In practice, banks combine probability of default, loss given default, exposure at default, and forward-looking macro assumptions. Good data quality is crucial for reliable provisions and reporting and audit trails. Make sure to cover expected credit loss, staging, lifetime versus 12-month ECL, PD, LGD, EAD, forward-looking macro assumptions, and why International Financial Reporting Standards 9 affects provisions and profitability. Question 7. What is a non-performing loan and how should a bank manage it? An NPL is a loan where repayment is seriously overdue, commonly 90 days past due, or the borrower is unlikely to pay. High NPLs hurt income, provisions, capital, and management attention. I would manage them through early warning signals, restructuring when viable, collateral enforcement when necessary, and disciplined collections. Prevention is better. Strong underwriting and monitoring reduce NPL formation before it reaches formal recovery action and losses. In your answer, talk about what makes a loan non-performing, the impact on provisions and capital, early warning signals, restructuring, collections, collateral recovery, and prevention through strong underwriting. Question 8. How would you handle an angry customer in a branch or contact center? If a customer is angry, I would first listen without interrupting and confirm the issue back to them. Then I would apologize for the inconvenience, check the facts, explain what I can do immediately, and set a realistic timeline for anything pending. In a bank, empathy alone is not enough. I must protect confidentiality, follow policy, document the interaction, and escalate when authority limits are reached. Be sure to mention empathy, active listening, fact-checking, confidentiality, policy boundaries, realistic timelines, documentation, and escalation. Emirates NBD values service quality, so show calm professionalism under pressure. Question 9. What are KYC and AML, and what red flags would you watch for? KYC is about knowing who the customer is, why they need the account, and whether activity matches the expected profile. AML red flags include unexplained cash deposits, rapid movement of funds, inconsistent business activity, sanctions links, and reluctance to provide documents. My approach is to avoid tipping off the customer, gather facts, follow escalation procedures, and file internal reports when suspicion is reasonable and documented. While answering, focus on customer identification, source of funds, transaction monitoring, sanction screening, unusual activity red flags, avoiding tipping off, and escalation through the bank's compliance process. Question 10. How is digital banking changing the way Emirates NBD serves customers? Digital banking matters because customers expect speed, transparency, and secure self-service. Emirates NBD has been visible in mobile banking, live, analytics, and paperless journeys, so I would show that I understand both convenience and control. A good digital product reduces cost to serve and improves engagement, but it must also handle cybersecurity, fraud monitoring, authentication, and clear customer communication. Trust is the differentiator in UAE banking today for customer adoption. Make sure to cover mobile banking, customer convenience, live and digital journeys, cybersecurity, fraud controls, analytics, cost to serve, and why digital transformation must balance speed with trust. Question 11. What is capital adequacy, and why do regulators focus on it? Basel capital rules make sure banks hold enough capital for the risks they take. Capital adequacy compares regulatory capital, such as CET1 and Tier 1, against risk-weighted assets. A well-capitalized bank can absorb unexpected losses, support lending growth, and maintain depositor and regulator confidence. I would keep the answer practical. Capital is not idle money. It is the buffer that protects the franchise over cycles and stress periods. In your answer, talk about Basel capital adequacy. CET1, Tier 1 capital, risk-weighted assets, loss absorption, depositor confidence, regulatory expectations, and how capital supports sustainable bank growth. Question 12. What is the difference between retail, SME, and corporate banking? Retail banking serves individuals with products like accounts, cards, personal loans, mortgages, and wealth solutions. SME banking focuses on smaller businesses that need working capital, trade services, and owner-linked credit assessment. Corporate banking serves larger companies with relationship-led lending, cash management, treasury, and trade finance. The biggest difference is complexity. Ticket size, documentation, risk analysis, and relationship management all increase as clients become larger and risk governance. Be sure to distinguish customer type, product suite, relationship depth, ticket size, credit assessment, documentation, and risk complexity across retail, SME, and corporate banking segments. Question 13. A customer has a high salary but many existing obligations. Would you approve the loan? I would not approve only because salary is high. I would calculate the debt burden ratio using existing loans, cards, proposed installment, and verified income. Then I would review bureau behavior, employer stability, account conduct, and product policy. If the ratio is above limit, I may reduce the amount, extend tenor within policy, request closure of obligations, or decline. Responsible lending protects both customer and bank. While answering, focus on debt burden ratio, verified income, credit bureau behavior, employer stability, existing obligations, policy limits, responsible lending, and alternatives to outright approval or rejection. Question 14. How would you balance sales targets with compliance and customer suitability? Sales targets should never override suitability, disclosure, or policy. I would start by understanding the customer's need, then recommend the product that genuinely fits, whether it is a card, deposit, loan, insurance, or investment referral. I would explain fees, risks, eligibility, and commitments clearly. Sustainable performance comes from cross-selling responsibly, because complaints, reversals, and regulatory breaches destroy value faster than a missed target would alone in practice. Make sure to cover suitability, disclosure, ethical cross-selling, customer needs analysis, fee transparency, regulatory compliance, complaint risk, and why sustainable sales matter more than short-term product pushing. Question 15. Tell me about a time you worked under pressure to meet a deadline. I would use STAR. Situation, task, action, result. For example, if month-end reporting was delayed because data from another team was inconsistent, I would first reconcile the critical numbers, speak directly with the owner, agree cutoff timing, and update my manager early. The key point is ownership without blame. In banking, delays affect customers, controls, and decisions, so communication is as important as the technical fix. In your answer, use the STAR method. Emphasize ownership, stakeholder communication, accuracy under time pressure, escalation, reconciliation, and learning from the situation without blaming other teams. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.